Welcome back, investors. Today we're going to be talking about common mistakes to avoid when investing. Whether you're a beginner or experienced investor, it's important to be aware of these pitfalls to safeguard your investment. So let's dive in. The first mistake to avoid is emotional decision making. Many investors fall into a trap of making investment decisions based on emotions, such as fear or greed. For example, panic selling during a market downturn or chasing after the latest investment fad. To avoid this mistake, it's important to stick to your investment plan and make decisions based on thorough research and analysis, rather than emotion. Remember, investing is a long-term game. It's important to stay disciplined and avoid knee-jerk reactions. Another common mistake is lack of diversification in your investment portfolio. Putting all your eggs in one basket can be risky. If you invest all your money in a single stock, sector, or asset class, you're exposing yourself to a higher risk. It's important to diversify your investments across different asset classes, sectors, or geographic regions. This can help spread the risk and protect your portfolio for potential losses. Make sure you do your research and create a well-balanced, diversified portfolio that aligns with your investment goals and risk tolerance. Investing involves costs such as fees and expenses, which can impact your overall returns. One mistake is overlooking the cost. For example, mutual funds and exchange-traded funds (ETFs) often charge management fees, transaction fees, and other expenses that can eat into your investment returns over time. It's important to carefully review and compare the fees and expenses associated with your investments and look for cost-effective options. Minimizing these costs can help you maximize your investment returns in the long run. Investing really is a long-term game. Having a short-term mindset can be detrimental. One common mistake is not having a long-term investment horizon. It's important to remember that investments can be subject to market fluctuation in the short term, but historically, they tend to grow in value over the long term. Avoid making investment decisions based on short-term market trends or trying to time the market. Instead, focus on a well-thought-out investment plan that aligns with your long-term financial goals and horizons. Before I reveal the final four, be sure to subscribe to the channel to stay informed and grow your financial knowledge so you can be financially free. Investing without doing the proper research is a recipe for disaster. Many investors make the big mistake of not conducting thorough research and due diligence to make important investment decisions. It's important to understand and do your research on the investment you're considering, including their financials, performance history, risk, and market trends. Don't rely solely on hearsay or tips from others. Take the time to educate yourself and make informed investment decisions based on credible information. Investing without having an emergency fund is a costly mistake. An emergency fund is a separate savings account that you can set aside for unexpected expenses, such as medical emergencies, job loss, or car repairs. If you don't have an emergency fund, you may be forced to sell your investments prematurely or take a debt to cover unexpected expenses, which can disrupt your investment plan and negatively impact your overall financial health. Make sure you establish and maintain an emergency fund before diving into investments. Ignoring risk management can also be a costly investing mistake. All investments come with risk, and it's important to understand and manage them effectively. One common mistake is not diversifying your investments to spread risk. Another mistake is not setting stop-loss orders or having a plan to manage your potential losses. It's crucial to assess your risk tolerance, set realistic expectations, and have a risk management strategy in place to protect your investments from significant losses. Investment scams are unfortunately common, and falling for one can result in the total loss of your investment. It's important to be cautious and skeptical of any investment opportunity that promises high return with little risk. Be wary of unsolicited investment offers like a get-rich-quick scheme or investments that lack proper documentation or transparency. Always do your due diligence, verify the credibility of the investment, and seek advice from qualified financial professionals before making an investment. And there you have it. These are some of the most common mistakes to avoid when investing. Remember to stay disciplined, diversify your investments, do your research, and manage your risk effectively. Avoid making emotional decisions. Have a long-term investment horizon, and be cautious of investment scams. Investing can be rewarding, but it's important to be vigilant and informed. Thank you for joining me today, and happy investing.